Hi, this is Professor Karen Lin. Welcome to the Financial Accounting for Undergraduate Students. In this video, we are going to talk about T accounts and trial balance. These are the other two very important tools for accounting students when we prepare accounting records and financial statements. Let's get started. In the previous videos, we talked about the starting point of an accounting system is transaction analysis. We are trying to find out how a transaction will affect financial accounting and the system. The next thing we are going to do as accountants is that we are going to record the events using something called journal entries. Each journal entry records the effect of a transaction to the accounting system. For example, when Chipotle issued new stocks, which consists of a par value and a premium that the investor pay in the market, the journal entry will have debit cash, credit common stock, and additional paid in capital. When you understand the language of accounting, you can read this entry as an illustration of Chipotle issue new stocks with $17 cash receipt and issued common stock and APIC. You can see journal entries are recorded when time passed by, so they were recorded in chronological orders. Writing journal entries by the order of time is just as if we are writing a daily journal recording what happened in our life. Now the problem is at the end of the month, if I'm asking you what is the ending balance of cash, that means how much cash do we have at the end of the month or the year? It would be very hard for you to figure out by looking at the journal entries because they record the transactions one by one. So we need some more tools to help us to summarize all these entries or summarize our journals so that we know at the end of the period what happened. Here is where a general ledger kicks in. A general ledger is basically a tool to summarize what happened for a single account. For example, a general ledger of a cash account would summarize what had happened to the cash account. For example, cash account has a beginning balance, which means it's the balance before the month or before the period starts, which is a balance that carry over from the previous period. So basically, this using the analogy of a bucket, your bucket has some water to start with. It has a certain level of water to start with. Then during this period, we talked about we issue new stocks and receive cash, right? Cash increases by $17. So this will be reflected in the general ledger by increasing the cash account, which is debit, allure, right? Asset account increases with debit. So cash increases with 17, and then that brings the balance to 498 from 481. So 481 plus 17 equals to 498. Ending balance equals to the beginning balance, adding or subtracting the newly incurred transactions during the period. Similarly, you will see common stock will be increased. Was a $1 beginning balance of common stock, and then the newly issued stock is recorded on the credit side. That would also increase the common stock from 1 to 2. So you can see if I ask you at the end of the period, let's say this is the only transaction that happened during the period. Now at the end of the period, if I ask you what is the ending balance or what is the water level of your cash bucket, you can tell me with confidence that the ending balance of the cash is $498 because you can read from the general ledger. So you can see basically general ledger is something that we sort our affect our transactions to different separate accounts. And this sorting process is called posting. So we are posting from the entry to the ledger. Now the ledger looks more complicated to us. So a simplified tool is called the T accounts. Each T accounts represents one account in the general ledger. For example, this cash T account represents the general ledger of cash. All right, it's less formal, but it's easier to visualize. So we are going to use the T account in this course rather than have students posting from the entry to a formal ledger. We will use the T account. Now, what is the T account? You can see a T account is basically something look like a T. For every T account, regardless of its nature, asset, liability, or stockholders' equity, the left-hand side is always the debit side, and the right-hand side is always the credit side. Now, we all know right now that debit does not necessarily mean increase or decrease. It depends on which account we are having. So, asset account increase with debit, and then liability and stockholders' equity account increases with credit. All the T accounts would start with a beginning balance. So in the previous page, we see that the beginning balance of cash is 481. So you would see beginning balance 481 in the T account. When we increase cash, we debit cash. So we write debit 17. And the ending balance of cash would be the 481 plus the 17, which would be 498. Now, what if the 17 is not on the debit side, but it's on the credit side? All right, if 17 is on the credit side, which means it's a decrease of cash, then when we calculate the ending balance, we will use the 481 minus the 17. All right, that's 464. So ending balance becomes 464. Now, let's say, if we have 481 on the debit side for cash and increase 17 in the same period, we decrease the cash for 3, right? What is the ending balance? Now, if this is our cash account, you would want to have 481 adding, because 17 is on the same side, so you want to add 17, right? And then subtract 3. So 481 adding 17, subtracting 3. So that's 495. All right, so that's how you calculate the ending balance of a T account. All right, one more example. Chipotle borrowed $4 from the local bank, signing a note. So we talked about this in the previous video. In this example, you debit cash because cash increased when we borrow money, and we also increase liability in the form of notes payable. That means assets increase by 4, liabilities increase by 4. Left-hand side equals your right-hand side. We debit $4 of cash. We debit $4 of cash. We credit $4 in notes payable. When you have a debit, you have a credit, and they are equal, right? So now we can calculate the ending balance of cash. If we stop here as the end of the period, our cash would be 481 plus 17 plus 4. So that's 502, right? And then for notes payable, it starts at the beginning, it has 77 in the account. That's the beginning balance. And then you are adding 4, so that's 81. So you can see T accounts are very useful tools for us to summarize the effect of the transactions. Now, again, by looking at the journal entry 1 and journal entry 2, if I ask you what is the cash ending balance, you won't be able to answer. But using a T account, we saw the cumulative effect of cash by the 2 different transactions. All right, we do the same. The textbook shows transaction from A to H, so we can do the same for transaction from A to H, and each transaction will affect one of these accounts. Now, at the end of the period, the collection of T accounts shows the beginning balance, the change of the account, and then the ending balance of each account. For example, for cash started with 481, increased by cash issuance, borrowing from the bank, so on and so forth, and then decrease for some other transactions. At the end of the day, we have $357 in cash. Now you can see it's very simple for you to tell what is the ending balance of any single account with the help of a T account. So I would ask you to read the textbook and try to figure out every single transaction, how to post. Again, posting means reflecting the effect of a transaction from the journal entries to the T account. Now, posting is kind of mechanical because once you write down the entry, it would be just mechanical to put them down in the T account. Remember, the left-hand side of a T account is always debits, right-hand side would be credits, okay? Debit on the left-hand side, credit on the right-hand side. Now, what you're doing is just mechanical. Because you debit cash, so you would put down the 4 on the left-hand side of the T account of cash. And then notes payable, because you already credit, and then you will put down the $4 on the right-hand side of notes payable. Now, pay attention. The key here is to do your journal entries correctly. If you do your journal entries correctly, you would be able to do your T accounts just mechanically. All right, now one more question for us is that how do I know that I did my T accounts correctly? Now, professor says that we are doing the T accounts mechanically. Now, let's just, for the sake of this discussion, in the ancient times, people do the T accounts manually, right? So, for example, you were posting the entry from the stock issuance, right? You wrote down debit 17 on a cash account. And then someone called you to go to lunch, and then you went to lunch, and when you come back from lunch, you forgot where you were. So basically, maybe you forgot to post the credit side of the common stock or the credit side of the APIC because you went for lunch and you forgot. All right, how do we know that we did it correctly? So here kicks in another tool called the trial balance. A trial balance is introduced to make sure at the end of the period we did our T accounts correctly so that the debit side equals to the credit side of all the T accounts we are having. To do a trial balance, we first list the name of the T account in the financial statement order, which means it's asset, liabilities, and stockholders' equity. And then we basically transfer the ending balance. For example, for cash, the ending balance is on the debit side, 357. We're going to transfer this number to 357 for cash on the debit side. Right? Now, similarly, we will transfer other accounts to this big table. Make sure you would transfer the amounts correctly and their sides correctly. For example, accounts payable usually would have a credit balance. If you put them under debit, you are making a mistake. Now, here I want to introduce something called normal balances. Normal balances. So what is the normal balance? Normal balance is the expectation that one account is going to end it with. For example, the normal balance of cash is debits. So a normal balance is where the side that where account usually increases. For example, for assets, normal balances are on the debit side. For liabilities and stockholders' equity, the normal balance of those accounts are usually on the credit side. For revenue, it's on the credit side. For expenses, on the debit side. So if you remember a law, remember where these accounts increase with, you would know the normal balances. Again, a normal balance is usually the side that an account increase with. If an account increase with debit, the normal balance of that account is on the debit side. So our trial balance would reflect the ending balance of an account and typically the normal balances of that account. If we add all the debit side numbers up and compare that with the credit side number, they should be the same. If they are not the same, then it means that you make a mistake somewhere. All right, can trial balance detect all the errors? The answer is no. Why? Because a trial balance can only detect if you make something asymmetric on your debit side or your credit side. But if I make a symmetric mistake, for example, I completely forget to transfer, to post one entry to the T accounts. So for example, I have a debit retained earnings credit dividends payable. I completely forget to post those to the dividend payable and the retained earnings account. That would cause an omission of the credit side of dividends payable and then the debit side of the retained earnings, right? When that happens, it won't be reflected in our trial balance because the mistake we have made has a symmetric effect on the debit and the credit side. So our trial balance would not be able to detect them. To summarize, this chapter we basically go over the most important part of the accounting cycle, where we start with analyzing each transaction and then record them one by one in the form of journal entries. And then we mechanically post the journal entries to general ledger in the form of T accounts because we want to know the summarized effect or the net effect of all the transactions to each single account. To make sure that we didn't make a mistake, we prepare something called a trial balance to detect any asymmetric errors in the debit side and the credit side that we have probably made in the first 3 steps. In the next chapter, we are going to talk about the income statement, and then we are going to go over the adjustment and the closing in the following chapter. All right, so this is the end of chapter 2, and I hope you enjoy this chapter, and this is the fundamental chapter of accounting, so you need to make sure you master all the techniques. If you have any questions, you're welcome to email me or come to the chat and ask me. The resources for the posting and the trial balance can be found from the guided help video 2-2. All right, I'll see you next week.